In this video we are going to talk about monthly dividend stocks that will pay your rent. So before starting this video, please like this video and subscribe to our channel for future updates. It's terrible to lose money during a short-term stock market sell-off like the one we're having right now. However, running out of money in retirement is a terrible prospect. That may appear to be self-evident. After all, running out of money at any point isn't exactly a pleasurable experience. However, the difficulty with running out of money in retirement is that you are no longer able to take on more employment or make sacrifices. While some seniors can afford to splurge, the majority of them are more concerned with purchasing food, paying property taxes, and visiting the doctor. None of them are optional expenditure, and reducing any of them would be excruciatingly uncomfortable, if not life-threatening. However, in 2018, running out of money in retirement is all too typical. Low interest rates have stifled yields on interest-bearing assets such as bonds and CDs. While many firms pay dividends, the S&P 500 has a paltry 1.94% yield at the time of writing. As a result, even those with small savings are finding it difficult to generate the necessary revenue for day-to-day costs. If this sounds like you, let me assist you with this list of low-risk monthly dividend investments. Changing your revenue strategy to a monthly basis is a significant move. After all, life is based on monthly billing cycles, from mortgages to vehicle payments to energy bills, and simply knowing your budget for 30 days rather than 90 days is a significant adjustment. A monthly payout also indicates that management is making a concerted effort to provide what investors desire, and that the investment has the cash flow to support more frequent distributions. It's simple to see why this technique is a tremendous path to retirement security when you combine all of that with careful fundamental examination of each option to assist you locate low-risk investments with big-time income. Stock 7. Pembina, PBA. Before you dismiss the inclusion of an energy stock, keep in mind that this is a pipeline company, not an exploration company. As a result, it's essentially a glorified toll collector in the industry, with no exposure to the risk of shifting crude oil prices. Pembina Pipeline Corp., NYSE, PBA, is a Canadian pipeline company that transports crude from oil sands deposits in western provinces. The pipeline business's toll taker structure provides more stability and less susceptibility to oil prices than O&G Wildcatters, albeit PBA stock has seen a lot of volatility over the last 3 years, and is down around 6% this year. The problem is that Pembina pays its dividends in Canadian dollars, resulting in some distribution instability. Ownership in a tax-free account is likewise a superior option. However, because the yield is currently at 5%, and could climb in the future, any potential currency risk is a minor worry here. Last year, Pembina bought rival Veresen in a deal that will create a massive, diversified pipeline and midstream company. Pembina's payouts, and, most likely, Pembina stock, should be more stable as a result of this diversification. Stock 6. Apple Hospitality REIT, APLE. Apple Hospitality REIT, NYSE, APLE, owns 241 hotels in the United States, which are managed by two major companies, Hilton Worldwide Holdings, NYSE, HLT, and Marriott International, NYSE, MAR, NASDAQ, MAR. The portfolio is well diversified across the U.S., with Apple's largest footprint in Texas, California, and Florida, in that order. Apple mostly caters to urban and suburban customers, with a focus on business travel rather than tourism. APLE went public in 2015, and the results have been mixed so far. Despite fluctuating between $20 and $16 a share, the stock is still trading at a discount to its IPO price. But keep in mind that real estate investment trusts aren't built to provide tremendous growth. They're made to provide safe, consistent income streams, and Apple Hospitality delivers just that. There's a potential that robust consumer growth in the United States will eventually translate into a boost for the hotel business. In the meantime, APLE stockholders may count on a tasty dividend of roughly 7.5%, paid monthly. Stock 5. Shaw Communications, SJR. Shaw Communications, NYSE, SJR, is the fourth largest telecommunications company in Canada. That may not sound like a glowing recommendation, but with a dividend yield of nearly 5% and consistent monthly dividends, it's just the kind of drowsy but dependable investment you're looking for if income is your top priority. Given its relatively poor growth prospects but impressive stability, Shaw is an intriguing investment at current levels. SJR stock has dropped 18% this year, but it appears to have bottomed as the market has become more unpredictable. Shaw's prior acquisition of Wind Mobile, now Freedom Mobile, helped it diversify its wireless, wireline, and cable services, and the subsequent sale of the Via West data center business allowed it to deleverage its balance sheet and focus more intently on its consumer business. There's also a chance that aggressive low-cost wireless options, similar to how T-Mobile, NYSE, PCs, earned points in the war with Verizon and AT&T, may allow Shaw to grab market share from the big guys. The company announced more than 85,000 new wireless subscribers and a 9% increase in ARPU in its most recent quarter, so there's reason to believe this growth approach will pay off in the long run. Furthermore, this wireless expansion assures that the monthly dividend is preserved and grows. Stock 4. Main Street Capital, Maine. With a monthly dividend yield of 6%, Main Street Capital Corporation, NYSE, Maine, is a solid income investment. Maine, as a mid-sized investment business, has a diversified debt and small private equity portfolio that is shielded against any individual risks to specific companies while also putting it in a strong position to profit from the American economy's rising tide. That is, for the most part, correct. Main Street has a proven track record, having invested in everything from software companies to an Arizona pizza chain to a variety of manufacturing. Main Street's investment income is increasing, and it is supplementing its monthly dividends with semi-annual payments. One point to consider is that Main stock is currently trading at a moderate premium to net asset value, suggesting that it may not be a good bet if the economy continues to deteriorate. Despite the skeptics, the reflation trade continued in 2017 and into 2018, and a reduced corporate tax rate and good consumer indicators promise well for this election moving forward. In the big view, cyclical investments like this have performed well as the U.S. economy has ramped up. As a result, both the asset value and dividends are expected to rise in the future, with Main Street continuing to be one of the most successful company development companies in the world. Stock 3. LTC Properties, LTC. LTC Properties, NYSE, LTC, has started to recover from the market's turbulence at the start of 2018 and again in October. And there's reason to assume that the company's long-term performance and generous dividend will propel it to long-term success, and fresh money could still find a terrific value in this cheap real estate investment trust right now. LTC owns senior housing and healthcare properties, including assisted living facilities and skilled nursing institutions split roughly 50-50. With the baby boom generation still approaching retirement, and living longer, demand for such services is only expected to rise. LTC hasn't increased its dividend as aggressively as other REITs, with its 19-cent distribution remaining steady since a 1-penny boost in 2016. However, the income potential is really excellent, with a current yield of about 5% and a sustainable payout ratio. The monthly dividend is a pleasant touch, but more importantly, LTC appears to be a secure, stable income option, given its long-term healthcare exposure and the United States' aging demographics. Stock 2. U.S. High Dividend Low Volatility ETN, HDLV. So, technically, this isn't a stock, it's a mutual fund. However, because this pick may be acquired in a brokerage account or an IRA and is a strong source of monthly income, it must be included. Because it is a leveraged fund that uses financial engineering to theoretically double the yield of its components, the ETRACS monthly pay 2x leveraged U.S. High Dividend Low Volatility ETN, NYSE-ARCA, HDLV, adds a little spice to a monthly payment portfolio. It's not a typical approach, and it comes with its own set of dangers, but the rewards are evident, with a current yield of more than 11% before taxes and fees. There are some intriguing potential benefits for those prepared to assume such risks. HDLV invests in high-yielding stocks such as Verizon, NYSE, VZ, AT&T, NYSE, T, and Duke Energy Corporation, NYSE, Duck, NYSE, Duck. Sure, each of these has its own set of difficulties, but they aren't going away anytime soon. Because this fund owns multiple of these brands, you'll have built-in diversification rather than placing all your eggs in one basket. And, in all honesty, if you want to increase your money, you should be pursuing up-and-coming tech stocks rather than dividend payers. There isn't really a better alternative out there if you want huge, monthly payouts. Stock 1. Realty Income, O. Realty Income, NYSE smiley face, likely is the best known, and certainly is the largest, of the monthly dividend payers. It has even registered the trademark for its slogan, the Monthly Dividend Company. The case for O stock goes beyond its monthly payouts. Realty Income has been a star performer for the last decade, seeing its share price rise 160% plus since 2008 even without dividends, compared with a 10-year return of roughly 90% for the broader S&P 500 index. Admittedly, it may be tough for O stock to replicate that performance going forward as the market gets a bit choppier in 2018. There were already concerns that the company was getting a bit overbought as it became a fashionable trade over recent years, and some of those fears remain. But there's still reason for optimism, particularly for new investors, now that O stock has corrected 12% after its declines in early October. Further, Realty Income recently announced Sumit Roy as Realty Income's new CEO, succeeding John P. Case. Previously, Roy served as an investment banker, where he handled $57 billion in real estate capital markets. He became Senior Vice President of Real Estate Acquisitions at Realty in 2011, working his way up to Executive Vice President of Acquisitions to Chief Investment Officer and Chief Operating Office. Roy knows Realty Income through and through, helping build the company to what it is today. Realty Income has a nicely diversified portfolio of tenants, including near 12% of revenue comes just from Walgreens Boots Alliance, Nasdaq, WBA, and 7-Eleven, two world-class corporations that are going nowhere. This safe right with a juicy yield has a lot to offer. The fact that you get paid monthly is just a bonus. What are your thoughts on our video? Please let us know in the comment section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.